Teleduct, as you know by now, if you've watched, listened, or read anything regarding their second quarter 2021 earnings call from a few weeks ago, reported some really good numbers. And on July 28th, the stock hit a high that day of $151 a share. Yet today, it's selling about $135 a share. So, what has materially changed for the business? Welcome to MGA Investing. My name is Dee. Let me be clear from the start. I own shares in Teleduct, but my intent here is not to get you to buy or sell a stock. That is your personal decision. My goal today is to present a clear way to understand the net losses that so many stock analysts have been whining about. The reality is, building the telehealth system from nearly scratch is not like putting a puzzle together. It's much more than that. It's figuring out what the puzzle picture is going to be and then trying to create the puzzle pieces out of, well, virtually thin air, then assembling a puzzle of a picture no one else has ever seen. So why are so many analysts so freaked out about the size of the net losses? Seriously, if they are, they're either disingenuous or don't really understand the magnitude of the newly developing telehealth industry. As always, whenever I produce a video, I have far more content to discuss than I actually have time permitted to do, so I'll try to concise this as much as possible. And I'm just going to touch on net losses in Q2 and give more context around that. Then I'll talk a bit about net loss per basic diluted share and what that means to shareholders and give you a better framework to think about it. I'll also touch on an HCSC deal and launching of MyStrength because I wasn't able to touch on it in my Teledoc post-earnings call video. When I take a look at net losses, this is what I see. I see large losses when you compare second quarter 2021 to the same quarter in 2020. It's even more dramatic when you compare second quarter 2021 to the entire second half of 2020. That is a $78.6 million larger loss than the entire second half of 2020. But none of this should come as any surprise to anyone. If it does, I'll have to ask you, where have you been all this time? Let me break this down for you. $83 million of that loss was stock-based compensation expense, which was only $22 million in second quarter of 2020. It had increased by $61 million comparing quarter over quarter, year over year. And loss is even more pronounced when you compare first half year over year. That is an increased expense of $129 million. Again, let me put some context around this increased expense. This is not the fault of mismanagement. This loss is directly related to the Livongo deal. These are the stock awards that are still vesting post-merger. This is not uncommon in any deal structure of this magnitude where stock awards are granted in lieu of cash to employees, especially key executive position. Look, I've said it before. This was a mega purchase for Teladoc. It would have been a mega purchase for any company. In case anyone forgot, the Livongo merger actually cost about $18.5 billion. Mostly done on stock, not on cash. Let me give you a brief summary of how that deal was put together initially. First, the deal was completed not that long ago. It was back on October 30th, 2020. That was just last year. Now, when the merger was completed, each share of Livongo's common stock converted into the right to receive a little over 0.59260 shares of Teladoc Health's common stock and $4.24 in cash without interest. Livongo also paid a special cash dividend equal to $7.09 per share to shareholders of Livongo back on October 29, 2020. The total consideration was just over $13.9 billion, of which $401 million of net cash, a little over $555 million related to the conversion feature of the Livongo notes guaranteed by the company, and a little over 60 million shares of Teledoc Health's common stock valued at the time of the merger at a little over $12.9 billion. Then on July 1st, 2020, Teledoc went on to complete the acquisition of InTouch for the aggregate consideration of just over $1 billion, which was, well, comprised of 4.6 million shares of its common stock, valued at the time to be just over $903 million, combined with $166.5 million of net cash. These were big acquisitions. It's going to take some time for Teledoc to grow into these new big shoes financially. There's no escaping that. Was it a costly gamble for Teledoc to acquire Livongo? No question. But if they didn't buy them, someone else would have. There's just not another Livongo on the market. The economy of scale from the Livongo acquisition and InTouch acquisition has enormous potential for Teledoc and for telehealth generally. This deal was essential to advancing the marketability of digital healthcare as a complementary option to how healthcare is served today. I still think the Livongo acquisition is just one of those acquisitions that had to be stretched. to get it, right? And if Teledoc remains disciplined, they have the opportunity to do something really much needed in healthcare. Off the $133.8 million net loss, over $46 million was directly related to the Livongo and InTouch acquisition. There's costs related to an acquisition. Specifically speaking, in Teladoc's case, this is partly due to higher amortization expense of the intangible assets from the Livongo InTouch acquisitions. Intangible assets like goodwill, which is the excess of the purchase price over the fair value of the net tangible and intangible assets acquired in a business combination, also included are client relationships related to those acquisitions, non-compete agreements. You also have patents and trademark. There's long-lived assets, which are things like property and equipment, internally developed software, and intangible assets. Also included in that big net loss number is Teladoc's cost to retire $31.4 million in debt. Most of this increased debt came from the exchange of convertible senior notes that are due in 2025 and the second quarter of 2021. You also had a little over $90 million of non-cash income tax expense, which reflected the recording of a valuation allowance given on the stock compensation benefits related to the Livongo merger that were recorded in the first quarter of 2021. So no surprises, just time to pay up for the merger and acquisition that took place nearly, a year ago. Let me hit on the net loss per basic and diluted share because this is a hot topic. I'm not going to dive too deep into minutiae here because the bigger story is what happened to the shares outstanding. Now, when looking at the weighted average number of shares outstanding, there was 79.6 million shares increase in shares outstanding compared to the second quarter year over year. I get it. That's huge, but it was also expected. The merger and acquisition has to be paid for and the business has to operate. Did shares get diluted during this time? Yes. Are you surprised? No. We all knew this was the case. I knew it when I bought Teleduct, but I believe in what the company is trying to do, so I'm playing the long game on this one. And because it wasn't going to be a significant portion of my entire stock portfolio today, I felt I could afford to sit on this potential golden egg for a while before it hatched. So am I overly concerned about the reported net loss? No, because I did my homework before I purchased and I knew what I was buying when I bought it. My hope is that you did your homework as well. And if so, there's nothing to worry about in this latest earnings call. Let's switch gears here. Let's talk about the HCSC deal. This new agreement with HCSC to provide Teladoc Health Suite of whole person chronic care solutions is a big deal. But unless you somehow work in the health space, you may not know how significant a deal this is for Teladoc and telehealth generally, especially if they can demonstrate the benefits of the platform during their contractual agreement period with HCSC. Let me back up a little for some of you folks because I know part of my audience are fairly new investors. Well, who is Healthcare Services Corporation, short for HCSC? Well, they've been around since 1929. They're one of the oldest health insurance companies in the U.S. It's a mutual insurance company, which simply means it's a customer-owned business. It also is listed as the sixth largest health insurance company by market share in the U.S. It's an independent licensee of Blue Cross Blue Shield Association that offers affordable marketplace plans with different tiers of coverage. What independent licensing means is it's simply an independent licensee of Blue Cross Blue Shield, and therefore they're able to sell products and services under the Blue Cross and Blue Shield names. It has 6 basic subsidiaries. It serves just over 17 million members with a variety of group and individual healthcare plans and services and life insurance products. They operate in 5 states. It offers its plans through Health Insurance Marketplace. Its reported revenue in 2020 was $47.3 billion and has over 24,000 employees across 5 states and 1,000 employees at its wholly owned subsidiaries. Another interesting fact is that they have an overall member satisfaction rate of 91.8%, an important factor for the possible member adoption rate and how Teleduct services could positively impact member retention for HCSC. Their plans consist of 710 network doctors and other providers and a total of 9,200 network facilities. So when you have a better understanding of who HCSC is, the Teledoc HCSC deal makes sense. HCSC is considered a pioneer in most states as it relates to health coverage. Both healthcare insurers try to figure out ways to exclude coverages. HCSC historically has tried to find ways to extend coverage to those most in need but ignored by other larger insurers. It was also the first to provide coverage to rural and small communities in the state of Illinois. It was also the first to launch a caravan as a mobile immunization program. It provided coverage to migrant farm workers in Texas. It was the first in New Mexico to offer PPO coverage, point of service coverage, electronic claims, exchange with providers, customer service for large group accounts, and in-hospital medical coverage on a per-visit basis. In Oklahoma, it was the first to create a mobile health screening and unit-free screenings for vision, hearing, glaucoma, blood, and blood pressure. In the state of Texas, well, they were the first to provide coverage for cancer treatment, catastrophic disease like polio, leukemia, diphtheria, and they provided health care starting at birth. So from all of their firsts, it makes perfect sense for them to lead the way on telehealth services for their members. The thing this deal will do is help pull other large insurers to the pipeline, because at the end of the day, each insurer is trying to bring more value per premium dollar spent at the lowest possible cost for their insurers to prevent attrition and to continue to grow. And as competitive as insurers are, I can expect they won't want to allow HCSC to gain additional market share traction. Let me touch a little on MyStrength. Teledoc announced the launch of MyStrength Complete, an integrated mental health service that combines app-based tools and coaching expertise with Teladoc's therapists and psychiatrists to provide consumers with more flexible access to quality mental health support when they need it to help consumers, manage stress, anxiety, depression, improving sleep, and mindfulness. The services are made available through consumers' health plan or employers. MyStrength is not entirely new. It's been around since 2011. Originally, it was designed to be used in conjunction with traditional mental health care to help enhance treatment. It was eventually acquired by Livongo back in 2019 for just over $10 million. The idea at the time was that the strategic acquisition would help Livongo complete their whole person platform, which is now integrated into Teladoc. Your question might be, why is MyStrength so important? Most people don't know where to start for mental health to get mental health help, and 69% of the people surveyed indicated it would be difficult, even overwhelming, to use multiple websites, mobile apps, or virtual care platforms to address mental health needs. It's also addressing a critical need in society. In many cases, the MyStrength Complete app will become the gateway that connects consumers with Teledoc therapists and psychiatrists and an entire mental health continuum of services, now all under one single umbrella, simplifying the experience for the consumer and their insurer. MyStrength is a tool that was created in direct response to what is not working in healthcare today. Livongo is at the heart of the operation. Their AI nudges is about getting people that need help, the help they need safely and privately. It was Alvin Toffler, the best-selling futurist author of Power Shift, the third wave, and my favorite, Future Shock, written back in 1970, where he foretold of the psychological implications that would be brought on by the coming technological revolution. Toffler said, "We must search out totally new ways to anchor ourselves for all the old roots, religion, nation, community, family, or profession are now shaking under the hurricane impact of accelerated thrust." He said that in 1970. He was also right when he explained society in terms of the law of raspberry jam. That is to say, the wider any culture is spread, the thinner it gets. And it's at this thinness that healthcare is most inadequate to address the overwhelming and continuously growing need of mental health care. We need new ways in a digital world to help us anchor ourselves, and Teledoc with MyStrength is best poised to lead the way. So in summary, I like what I heard in the 2021 Q2 report. Does the company still have challenges to overcome? Absolutely. As I've already mentioned, the Livongo and InTouch deals were huge, and it will take some time to pay for that merger. One thing is for sure, and that is the pandemic has revealed the absolute necessity for telehealth services. Telehealth, and specifically Teledoc, are positioned to meet two growing market demands: the demand for affordable and more accessible healthcare for an aging baby boomer population, and accessibility to quality healthcare for rural areas as well as hard-to-reach urban areas. Teledoc is a growth company on the dawn of the creation of an entirely new industry within an existing, aging, bureaucratic, stodgy, deeply entrenched in its ways and digitally handicapped industry. It has an opportunity to transform healthcare just like Amazon transformed shopping. Teledoc, no question about it, is a big bet. If they pull it off, the world's in a better place, but it will require some starts and stops over the next 5 to 6 years as it finds its way. If you can't handle that, well, you might want to sit this one out. The reality is, Teledoc is a 21st century and beyond utility that must be built. Think of what the U.S. healthcare system would have been like without it during the pandemic. So me, I'm holding to my 100 shares of Teledoc, and I'm not going anywhere except to maybe accumulate more shares as the opportunity continues to present itself and where it makes sense for my portfolio. A lot of the analysts like the stock at 120. Well, will it get there in the near future? Nobody knows. I'm just willing to bet with today's cheaper dollars that Teledoc will be worth significantly more 3 to 5 years from now than it is today. So I got time. I'm willing to wait for this one to come to me. Thanks for watching, and if you found value in this information provided in this video, hit that like button and please subscribe to make sure you have access to the most comprehensive coverage and stock analysis of Teledoc on YouTube. Now, you may not always agree with me, but you can be guaranteed I will give you a lot to think about. See you in the next video.